Welcome to our weekly livestock market update. I'm Brownfield news anchor reporter Meghan Grebner. With us is University of Missouri Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
All right, let's get into it this week. Another week where we're not seeing a ton of movement in the livestock markets. And when we see that on a Friday, what does that mean, and what does that mean for our livestock producers?
Yes, again, I do think we've seen a lot of quiet movements this week. I saw hogs were up on Tuesday. We've kind of slid back as we've gone through the rest of the week, up a little bit on feeder cattle prices. But frankly, it's been a fairly quiet week. You look at the meat markets. We've also seen some movement, but frankly, not all that much so far. I wonder if we're not starting to get in a situation where markets are beginning to look for where's that next direction really come from. And are we going to drive these markets lower as we move ahead, or is there some possibility for more market strength as we move ahead? So maybe a week where we've been searching a little bit for the news that drives markets as we move ahead.
But as we talk about that, we've seen really a backward slide in some of those markets, specifically the hog market in the last month or so?
Absolutely. I think, when you look there for a while, we were hitting 25 days in a row of some lower hog prices. So I think it's a market that's beginning to come to grips with the fact that we're going to have pretty ample supplies of pork as we move through the remainder of 2016. And we keep holding out there, Megan. We get to the end of the year and we're going to be really close on Shackle Space on the hog side. We could be 4 or 5 weeks perhaps where we're really, really tight. And so I think the idea that we have to push those prices higher, we've been dealing with over the last month. But when you look at this week, at least we've gotten a little bit of flatness as we move through the week. So maybe we can get off that train down that we've seen for the last month or so in lower hog prices.
We'll definitely take maybe some moderate movements opposed to some of the volatility that we've seen in some of those other markets as well.
Absolutely. I look. If you look at belly markets, for example, we've been all over the board in terms of pork belly market prices for the last several weeks, searching for kind of where is that common ground, and hopefully we can start to see a little less volatility in some of those markets as we move ahead. That's true.
I want to talk a little bit, we've talked about markets just in general and maybe a little bit of a backwards slide or a sidestep in prices. One of the reports I read this week was the Sterling Beef Profit Tracker, and it showed significant declines from 2015 and 2014. Can we talk a little bit about what that means, and especially when it looks at those numbers for cow-calf producers?
Yeah, absolutely. Well, I always like to start with the fact that we are talking about feeder cattle prices that are 30% lower relative to a year ago when we think about where we are in 2016. So it's not surprising when you see cow-calf returns that we have come off of those records. A $500 return per cow is pretty phenomenal that we saw back there in 2014. And yeah, we did slide as we went through 2015, and really cattle prices, feeder cattle prices in particular, that last 3-4 months of the year was pretty tough on the downside. We've continued that in 2016 with lower prices. I remind folks that even $150 a cow return relative to historical averages is still good. And I know that's hard to say whenever we've come off of $500 returns, but over the long haul, plus $100 on cow-calf returns is a pretty good return that we see. I look ahead in 2017, and perhaps we're going to see us kind of stabilize here for a little bit, with perhaps another year of 2017 where we can get above $100 a cow on returns. We'll have to wait and see what kind of pressure we continue to see on feeder cattle prices, but perhaps we're starting to find kind of a new level after coming off of those historical high years.
Scott, as we take all of that into consideration, and we talk about that pressure in the hog market, and we talk about the pressure on Shackle Space going into the end of 2016 and the beginning of 2017, are we seeing some of that increased pressure, similar type increased pressure for cattle, or is it specific and maybe unique to the hog industry right now?
Well, I think when you look at Shackle Space, that's certainly unique to the hog industry. I think when you look at cattle in particular, we've got plenty of space in feed yards, because you see a few cases where we see feed yards trying to actually run cow-calf enterprises in some of those yards. And I think we have plenty of shackle space sitting there right now. I guess you could look ahead in the next 3 to 5 years and suggest maybe we run into some issues in terms of capacity on the cattle side, especially coming off of these lows, and the fact that we've lost some slaughter capacity on the cattle side. That can come back to haunt us longer term. Right now, I just don't see that as one of the issues that we really face. Yeah, we've got a lot of supplies of cattle relative to a year ago, or beef relative to a year ago, but coming off of some pretty low levels, I think we have plenty of capacity on that side of the equation.
We still continue to talk about the economy and the ag economy in general. USDA came out with some pretty big numbers for corn and soybeans last week. As we look at those numbers and we look ahead to slimmer margins for livestock producers, really across the board, how do producers leverage that information and prevent maybe or work to maximize their returns for 2017 when those margins could be even slimmer?
Yeah, well, so you raise a really good point. I remind us all the time that thank goodness from a livestock perspective that corn prices have come down as much as they have. I know corn farmers don't like to hear that, but it has made what would otherwise be a lot of red ink in cattle and hog sectors, frankly, keep us in the black. Even though hog prices have moved down, I think feed prices have moved down along with those hog prices, and have kept the bottom line looking a lot better than we would have thought otherwise. I think as you look ahead in 2017 and that idea of what can you do, it's much easier, I think, to see expense creep or a little loss of efficiency when you're seeing those record returns. I think it's important to really re-examine every component of that cost side of the equation, because ultimately those that have the lowest cost are the ones that stay in business for the long haul. And I know, again, sometimes we don't like to have that discussion, but I think right now, as those margins get a lot tighter, the idea of what can I do on the cost side to try to make sure I'm as efficient as possible is certainly one of the areas we have to look at. As you and I have talked about, the other side of that is, what do you do in terms of risk management? I'd remind us, I don't think we're done with volatility. So if you want to think about that risk management side, locking in one side of the equation, that is locking in hog prices or cattle prices without locking in feed costs, might be one we'd want to think twice about. I think you can find yourself, when you're only locked in on one side of that equation, getting in trouble pretty quickly. We've certainly seen that in the past.
And sometimes a steady pace is better for us as producers in the long run, opposed to capitalizing on big jumps and big drops in the markets as well. Absolutely.
I think that idea of, let's lock in 10% to begin with, and given where we go, we lock in a higher percentage. None of us know exactly where these markets go long term. If I did, I wouldn't be here visiting with you probably this afternoon. But the idea that direction, and number one, understanding those costs of production, I think it helps on the when should I pull the trigger on risk management. What's my return really look like, and is that a time that, hey, let's go get 10% of that risk out, and maybe we live for another day here. Understanding it's not an all in, all out. If we knew exactly where markets were going, that all in and all out kind of strategy on risk management works really well. But when we don't know, setting goals that allows us to sell along the way, I think, is a good strategy.
Scott, Cattle on Feed comes out this afternoon. Any big surprises expected, or is it more steady as it goes at this point?
Yeah, I think when you look at pre-report estimates that we have out, we don't have the report yet in our hands. We do expect more cattle on feed to be reported August 1, up a little over 1% relative to a year ago. Marketings, since we had 2 less slaughter days in July, I expect we're going to actually see marketings for this year actually down a little bit relative to the previous year. But we have to remember those 2 less slaughter days had a lot to do with that. A lot of variability in the estimates pre-report on place placements that we expect to see in July, from 5% down to almost 4% up. It tells me we're searching for just how many cattle placements we're going to have, and whether we're going to continue the strong pace that we've seen for a period of time. Most folks, if you take the average of all that we have out there, will say placements are going to run pretty much flat relative to a year ago. We'll see if we get a surprise out of the report. Another 4% up on placements might suggest where we head for cattle prices next week and give us a direction we really don't want to head.
Well, we will check back in with you next Friday. Good to see you.
Good to see you as well, Megan.
Have a great week, Scott.
Yep, you do the same. Take care.
To have our weekly livestock update delivered to your email box every Saturday, visit our website, brownfieldagnews.com, and subscribe there. I'm Meghan Grebner on Brownfield.